Alright guys, so welcome to another one. This is going to be a video on how to identify the trend or how to trade with the trend. Alright, so first we can clearly see that price from here at this point in time, price is moving in an up direction or in bullish momentum. Right, so somewhere along this part of the market, somewhere over here is where price tapped into a level and respected that level, causing a new trend or a new momentum inside the market, right? So here we can clearly see from somewhere around here, price has now reversed to the upside or started moving in a bullish momentum, right? So always what I encourage you guys to do is mark out your lows. So this would be the most recent low. However, before price put in place this low, price has put in place a low just before that, right? So there is our low, and we call this low a break of structure because price is still in a downtrend at this point in time, right? So we've marked out our low. Now let's go ahead and mark out our high, which is over here. Alright, so now we can see there is our low. Price took out that low, causing a break of structure. Price stepped into a higher time frame demand zone or a point of interest, and then price reverses back up, taking out the previous high, causing a change of character. Right, so a change of character is just the very first break of structure. A change of character is just the very first break of structure into the new direction or into a direction that price is now shifting. Right, so we clearly have marked out our lows and we've marked out our highs. So then we will go ahead and mark out our new low. And the reason why I'm doing this is that before we before we look for a new trend within the market, or before we look for new momentum in the market, you always mark out your highs and lows. Now you can either mark them out by labeling them a high or a low, or you can go ahead and mark out some tiny marks at the point of the new high and at the new low, which is these little circles over here. I prefer labeling them, it's much easier. And when a break of structure or a change of character happens, it's just easy to identify or easier to label as a break of structure or change of character, right? So from this point in the market, you can clearly see that price put in place a new low, put in place a high, takes out the new low, goes back up, takes out the previous high, putting in place a new high, and then retraces back into a level that we would have looked for an entry point in from, right? So then price goes back up, causing some liquidity over here. Price goes back up, taking out the previous high, putting in place a new high, and then price retraces back into a level that we would have looked for another trade from the upside, right? So, but before we look for any trades, we want to identify the trend, right? So the trend or the momentum that the market is currently shifting in. So we have our lows got taken out, causing a break of structure. We have the high, price took out the high, causing a change of character. So the very first change of character indicates to us that price is now interested in moving into a new direction, which in this case, price is interested in moving into a bullish direction or causing bullish momentum, right? So after we marked out our low, price never took out the lows again, it took out the previous highs, right? So what I'm going to do at this point in time, I'm just going to follow along in what price does. So low, Price takes out the previous high, price puts in place a new high, retraces into a level, causing a new lower high, and then puts in place a new higher high. Right, so what I would like you guys to look at this point in time, this would be an easier this over here would be an easier level to identify that price is now interested in moving into a bullish direction, right? So because we have a change of character, which is the very first break of structure into the new direction, and then price puts in place a new high, price retraces into a level that we would have taken a trade from, and then price takes out the old high or the previous high, putting in place a new high, right? So at this point in time, it's clear to us that price is now interested in changing its momentum or changing its direction. First off, we have a change of character, then we have a break of structure. So this is what we would call a flip zone. A flip zone is just the third break of structure into the level that we are looking for, and maybe later I will show you how to use flip zones when trading supply and demand. Right, so at this point in time, I would have used my Fibonacci or my Fibonacci tool from the most recent low, which is either this one over here or this one over here. Doesn't really matter. They're all within a range. They're all within a range. None of them caused a break of structure to the upside, so both of them are valid. So, but because I marked out my low over here, I am going to pull my Fibonacci from here to my most recent high, which is over here, which is this one over here. So I'm going to just lay it on top of there, and as you can see that we have a premium zone where price comes to mitigate, and we call that a demand zone, right? So from here we would have looked for a position or a contract into the direction that price is moving towards, right? So which would have been a bullish run to the upside, targeting our previous highs, targeting our previous high, and then with our stop loss either below this low or below this one over here, and we would have gotten a clean run to the upside, right? So that is the simplest way to use the trend or change of characters and breaks of structures to your advantage. Like I said, I'll show you later in another video, or maybe even in this one, you never know, how to identify a flip zone and how to use a flip zone, right? So at this point in time, we can very clearly see that price is now creating highs and higher lows, which makes it a bit easier for us to identify a level in which we can take a trade from, either to the upside or look for an entry point that we can take to the upside, right? So what we're going to do is just mark out the highs and lows in the direction that price is now moving into. So that's over here is a higher low, this over here is a higher high, this over here is a higher low. Let me just remove that. That over here is a higher low, and then we have a higher high, and price puts in place another higher low. And the reason why I'm not using this one over here, is because it's internal. Price still comes to take out this low, right? So this is an internal low over here. So let me just mark that out. This over there is an internal low. Price comes and takes out that low before it goes back up, taking out the previous high, right? So from this would be the easiest way to identify a trend, and it makes it a lot easier for you to look for positions or contracts within the market that you can take trades from, right? So like I said, you can either mark out your highs and your lows using the circles, which is this thing here over here, the pencil. Alright, so let me just put that back there. And that is part of a drawing. Also, I do not use any grids on my charts. It's very, I find the grids very annoying, or it messes with the way I see the market. So, right, so either you mark out your highs and your lows using the circles, or you can go ahead and mark out your highs and lows using the lines. Me personally, I prefer the lines because it's a lot easier when it comes to a change of character or a break of structure to mark them out. Right, so over here we have another break of structure. So price is clearly in an uptrend or a bullish trend, and then which makes it easier for us to identify levels that we can take trades from. So as you can see over here, we have marked out our Fibonacci, laid it on top of the high, laid our Fibonacci on top of the high, price drops back into the yellow level and the red zone. So that's why I have a red line on my Fibonacci. So the red zone is anywhere below that. If price closes below that, I would not be looking for any trades, because that indicates that price is still interested in going into the level that it's currently moving. And from here, that would have been, say price came down from the high. If price was to close below here, pull back slightly, I would not be looking for any trades over here. But since price came back into this level from the high, came into the level and then closed far above the level, even above the yellow zone or the premium zone, and then continued into the up direction, right? So that makes it a lot easier. Why I have a Fibonacci that has a yellow, gray, and a red level. So anywhere below the red level for me is not something that I'm interested in. It's not a trade that I'm looking for, or a contract that I'm willing to fill. Right, so it's imperative that you guys identify a trend on the higher time frame and then jump all the way down to, let's say from here you jump down to the 3-hour time frame, and then from the 3-hour time frame, if everything matches up from the 4-hour to the 3-hour, if everything matches up on there, you jump down to the 2-hour time frame, and then you can see there is a lot more internal moves or internal highs and lows that are being formed. And let me show you, when identifying external highs and lows, how to use the internal highs and lows to catch trades into the direction that you are looking for. Right, so as you can see over here, alright, so after we've identified the trend in which price is moving on the higher time frame, we can use the lower time frame like the 1 hour or the 45 minutes up to 5 minutes or down to 5 minutes to our advantage, looking for a trade to the upside or into the direction that we are now looking for, when or the momentum that price is moving into, right? So from here we can clearly see price is in an uptrend. So this is a good, let me say, this is a good trick for when you have marked out your highs and lows on the higher time frame, you've missed out an entry on the higher time frame. So what you will go ahead and do is jump down to the lower time frame like the 5, 15 or up to 45 minutes, and you can go ahead and mark out a level that you can take a trade from on the internal time frames, right? So as you can see, these are all external highs and lows. Over here we all have the external highs and lows that we've marked out on the 4-hour time frame, right? So these are all the external highs and lows on the 4-hour time frame that we've marked out. And then internally we can see that there are some more highs and lows formed. So those are the highs and lows that you are going to use to your advantage when looking for a trade into the direction that price is moving, right? So we've missed, say for instance, we've missed out a trade on the external time frame, like the 4 hour. So now what we are going to do is, since we have missed out the trade on the external time frame, we are going to jump down to the lower time frame, which is, let's say, the 15 minutes. Let's jump down to the 15-minute time frame. Right, so let me just find this one. So we jump down to the 15-minute time frame, and we can go ahead and identify a trade on the 15-minute time frame or 5-minute time frame, right? So here are the external highs and lows. These are the external low. This is the external low. This is the external high. So we've missed a trade from over here. We've missed a trade from the external high or low, right? So let's call this our external. Let's call this our external low. So we've missed a trade from here. We weren't in time. We missed it by a pip or anything like that. Now we are within the internal time frame, right? Targeting our external high for low, for take profit, right? So at this point in time, we can clearly see that from the external low, price is now interested in reversing into the up direction again. So what we are going to do at this point in time, we'll mark out our most recent internal high or our internal low, depending on the side the market is moving into. So this would have been our high. And since price came up and took out that previous high, we are going to call that a change of character. Alright, so after the change of character, we would go ahead and mark out the buy to sell level that caused this change of character. We're going to pull it slightly across. As you can see over here, price mitigates that level, and we are going to now have two levels that we can take profit from, right? So from here, we are going to target the internal, right? So once again, stop loss is always just put it below the lows, either below this low, and we are going to target our internal highs for take profit 1. Right, so this over here is going to be our TP1, and then over here we are going to have our TP2, and then we're going to pull it slightly across, and we will see that even if we missed this external trade or this external reversal, we now have an internal level like the 5 minutes or 15-minute time frame where we can take a trade from to the upside, right? So only after we've marked out our highs and our lows will it be easier for us to identify a position or a level where we can take a trade from into the direction that the market is moving, right? So seeing that our TP1 was hit, we now have a break of structure, and we will mark out the level. We'll mark out the level that caused this break of structure, and over here, as you can see, we have a lot of imbalance over here. Right, so there's a lot of imbalance over here. Price taps into this imbalance and then continues to the upside, causing another break of structure. However, since we are already in this trade, we're just going to let price play out, and then we are going to look for a new level or entry point that we can take a trade from. Right, so it's that easy, guys. It's not that hard. These are the things that many traders fail. These are the things that many traders fail to understand or fail to do. That's why there are so many losses and so many failed traders that struggle to take or that struggle to profit from the market. It's really not that hard to identify or to use market structure to your advantage. The only thing it takes is a bit of work or it takes a bit of time for you to make a lot of money from the market. It's not that hard to do. Only thing you do is you'll go ahead and mark out your external lows first, and then you will go ahead and jump down to the lower time frame only if you've missed an entry point from an external time frame, right? So over here you can see the demand zone over here was a bit bigger than it was on the lower time frame. On the lower time frame, we stood a bit more of a chance to enter from a different position, and then over here, slightly to the right side, we can also see that price tapped into imbalance, right? So that at that moment over there in the 15-minute time frame, let's jump down to the 15-minute time frame, so we can see why price decided to move below our demand zone, in which case our demand zone was located over here. Our demand zone was located over here, but on the higher time frame there was a bit of imbalance slightly below the zone, and that's why I always encourage you guys to put your stop losses below the previous lows, which in this case this was my previous low. And then let's go over to the higher time frame again, just so we can see why it is that price ignored, or not ignored, but slightly just tapped below our zone. And these are the things that knocks traders out of a position before price continues into the direction that it actually wants to move into. Right, so over here we have a tap into imbalance, and from the tap into imbalance we have a clean move to the upside, taking out both the internal highs and the external high. And then our stop losses would have been either below this low or below the internal 45-minute or 15-minute low, targeting all the highs, right? So on the lower time frame this would have been a higher risk, but on the higher time frame this is a lower risk based on what we are seeing over here. Alright guys, so from going from the external, from marking out our external highs and lows, we've jumped down to the 15-minute time frame to identify a level or an entry point that we can fill our contracts from to the upside. Alright, so the same thing on the other side over here. Let's go back up to the 4-hour time frame. We can go back up to the 4-hour time frame, take our Fibonacci from the level that caused the highs to break, and then we can see from here price taps into the premium zone, which is our demand zone, and price continues to the upside. However, if you look slightly to this side over here, price never falls our premium zone fully. So this over here would have been our premium zone. Price never comes to fall this level fully. It just taps into a 50% zone. So I'll make another video on why price does this, and then takes off from there. Right, so price taps into the 50-minute zone, 50% zone, and then takes off from there. And then as you can see over here, price then comes directly into the premium zone or just above the red zone, right? So I've said it also before in this video. Price comes just above the premium zone over here and over the red zone, and then price takes off into a new direction again, right? So these are all the small things that builds your that builds the skill of a trader. I hope this video is easy for you guys to understand. If you do not understand anything, please comment down below. I'll explain it again to the best of my abilities in a shorter video. But if you guys do not understand anything, please comment down below and I will explain it again or create another video on it for you guys to understand it a bit easier. So once again, before I go, what I would like to say is always start off on the 4-hour time frame where you can identify a trend and then go down time frame by time frame from 4 hour, 3 hour, 2 hour, then 1 hour, or whatever time frame you feel comfortable with to mark out your highs and lows. So first you start off by marking it out on your 4-hour time frame, then go and move down or to the lower time frames. Identify an entry point if you have missed an entry point on the higher time frame. Move down in time frames like the 15-minute or 5-minute, and then identify a zone or a level in which you can take an entry point from or fill a contract from on the lower time frames, targeting the external highs or lows that you have marked out. Alright guys, so I hope this video was helpful. If you guys find it informative, please drop a like and subscribe. I will see you on the next one. Also comment down below what you did not understand, what you would like me to explain a bit some more. And peace. I'm going to see you on the next one. Drop a like and subscribe if this video helped you. And I'm out.